Welcome to the Gifu Forex trading course. The Japanese candlesticks are formed through the opening, highs, and lows of bars in any given time frame. Here are examples of Japanese candlesticks. The bar on the left-hand side signifies a bullish interest bar, while the bar on the right-hand side signifies a bearish interest bar. Here are the highs of these bars and lows. The real body. The difference between these two bars is the opening and closing level of the bars. We can see the bullish bar opening is after the low, and the close comes in before the high, while the bearish bar opening is after the high, and the close is before the low. The highs can be called the upper shadow, and the lows can be referred to as the lower shadow. In advanced technical analysis, the upper shadow can be tagged as bearish pressure, while the lower shadow can be tagged as bullish pressure. Therefore, a bar that has its close level higher than its opening level signifies a bullish bar, while a bar that has its close level lower than its opening level signifies a bearish bar. The bullish bar is displayed as a green color, while the bearish bar is displayed as red. But this is not a rule, because there's room for traders to choose any type of color they wish to differentiate the bars on their trading chart. Therefore, for easy detection of price formation on your trading chart, make sure you choose colors that are suitable for you as a trader. Importance of body sizes of candlesticks. Candlesticks can be long or short, and this represents volume. Therefore, long bodies signify strong bullish or bearish interest, while short bodies signify weak bullish or bearish interest. So whenever you see a long bar formation on your trading chart, it's a signal of strong buying or selling interest. And short bars are a signal of weak buying or selling interest. Importance of shadows of candlestick. The upper and lower shadows of the candlestick give us important information about the trading sessions of participants in the market. Upper shadows signify the session high, while the lower shadows signify the session low. A long shadow signifies trading activities occurred far away from the open or close level of that bar, and a short shadow signifies trading activities occurred near the open or close level of that bar. Here are examples of shadow formations of bars. If a Japanese candlestick has a long upper shadow with a short lower shadow, it simply means buyers showed a stronger sign of interest by bidding price higher. But later, sellers stepped in and pulled down the price to the opening session of the bar. Likewise, if a Japanese candlestick has a long lower shadow with a short upper shadow, it simply means sellers showed a stronger sign of interest by bidding price lower. But later, buyers stepped in and pulled the price upward to the opening session of the bar. Sometimes both the buyers and sellers may bid price at the same level of equilibrium. That's the same length of shadows of high and low. Candlestick patterns. Candlestick pattern is the language of the market. This is the most powerful, simple, and easy way to understand the trading concept of technical analysis. The inability of traders to understand this language will always lead to financial disaster. This candlestick's charting technique was originated from Japan, and that is why it's been referred to as the Japanese candlestick patterns. This form of charting technique was used by the Japanese traders since the 1700s, and this is the most popular charting technique used by traders because they are visually easier to interpret. The Japanese candlestick charting technique focuses on the relationship between the bodies and wicks of its formation. There are lots of candlestick patterns, but I will show you the most reliable and powerful ones to implement for trade decisions in the market. The first candlestick pattern you need to know about is the engulfing bars. This bar can engulf more than one previous candle. But to be considered as an engulfing bar, it must totally engulf at least one candle. The engulfing bars can exist in two forms and are the bullish engulfing and the bearish engulfing bar. As we can see, the bars consists of two bars each. The bullish engulfing bar on the left-hand side engulfs totally the previous bearish bar, and that is why it's called bullish engulfing, while the bearish engulfing bar on the right-hand side engulfs totally the previous bullish bar, and that's why it's called bearish engulfing. You have learned about the opening and closing price levels. In the case of the bullish engulfing bar, it shows us buyers are in control of the market, and the bearish engulfing shows us sellers are in control of the market. Here's an example of the bullish engulfing on the trading chart here. We can see how it led into a bullish move after the previous bearish rally at the left side of this market here. Here comes the bearish engulfing after a long period of the bullish rally on the right side of this market. We can see how the bearish engulfing bar switched the bullish trend into a bearish rally. Not all engulfing bars are tradable. There are other technical factors that have to be combined before implementing them for trade opportunities. In one of the classes in this tutorial, you will learn about those factors. The next candlestick pattern on the list is the doji bar formation. This is another most important Japanese candlestick pattern. These bars can exist in different variations, and they are the long-legged doji, the star doji, the dragonfly doji, the gravestone doji. These bar formations are opposite information. We can see the difference between the long-legged doji and the star doji is the length of the shadows. The long-legged doji has long shadows, while the star doji has short shadows. But the long-legged is much more powerful than the star doji. While the difference between the dragonfly and the gravestone is the absence of upper shadow on the dragonfly and the absence of lower shadow on the gravestone. Whenever this bar formation forms on the chart, it tells us the market opens and closes at the same price level. It signifies both the buyers and sellers are in a state of equilibrium. This bar tells us the market is in a state of indecision and no one is in control. As we can see, this is the highest price level, the lowest price level, the opening price level, and the closing price level. Whenever this pattern occurs at the extreme of an uptrend or low trend, it suggests there's a possibility of market reversal. Here's an example of the doji bar formation on the trading chart here. We can see the market was in a bullish rally. The doji formed at the high of this bullish trend. We can see how it reversed the trend into a bearish trend. Likewise, at the low of the bearish trend here, we can see how this doji bar formation led to a bullish trend. Whenever the doji formation occurs at high or low of a trend, always focus your attention on the opposite shadows of the existing trend direction. A strong close of the bar, which is opposite the existing trend of the doji high or low, does suggest the probability of a trend reversal. We can see when the next bar, which formed after the doji here, closed above the high shadow, it led into a bullish rally. Likewise on the bullish trend here. A strong bearish close of the bar below the doji low shadow led into a bearish move to the downside. The doji is a powerful reversal candlestick pattern you need to carefully study and pay close attention to whenever it appears on the trading chart. The next Japanese candlestick pattern on our list is the morning and evening bars. This bar consists of 3 bars. The bullish bar is regarded as the morning bars, while the opposite is the evening bars, which signifies bearish interest. The morning bar's first candlestick is bearish, which indicates the sellers are still dominating the market. The second candlestick transformation can be a bearish or bullish candle but with a low volume. This signals the sellers are still active, but with a weak interest in control of the market. The third candlestick is a bullish bar that gapped up on the open and closed above the midpoint of the first candle of the formation. This candle signals a high possibility of a reversal of the bearish trend into a bullish trend. The morning star is a candlestick that shows us how buyers took control of the market from the sellers in a market. Therefore, whenever this candlestick pattern occurs at the support of a bearish trend, it signals a possibility of a powerful trend reversal to the upside. Here's an example of the morning star candlestick, which formed at the support of a bearish trend. We can see how the candlestick led into a bullish rally. Here's another good example, and we can see how it led the bearish rally into a bullish trend. The second bar sometimes can be a formation of a doji candlestick. The doji bar signifies a state of indecision, but later the bulls stepped in and exercised a strong bullish interest. Here comes the opposite of the morning star, and that's the evening star. This candlestick pattern has a technical bearish implication. Whenever it forms on the chart, it suggests an imminent bullish reversal of a trend into a bearish trend. The evening star usually appears at the top of a trend. The first candlestick is a bullish candle. The second candle is a small candlestick, which can either be a bullish or bearish candle. It can sometimes be a doji star. The third bar is bearish, which gaps down and closes below the midpoint of the first candlestick of the pattern. The first part of the candle, which is the bullish candle, signifies that the buyers are still in control of the bullish trend. The second candlestick shows that buyers are still in control, but there is now a reduction in the bullish interest. The third gapped bearish candlestick indicates that the buyer's force to move the trend upward is over, and there's a high possibility for the bears to take over the trend to the downside. Here's an example of the evening star. We can see how it put an end to the previous bullish rally here, and how the market was reversed into a massive sell-off. The next candlestick pattern is the pin bar. This is a very powerful candlestick. In fact, due to my years of experience, it's the candlestick pattern with the highest winning rate in my record. The candlestick pattern is a single candle formation. This candlestick can exist as the bullish pin bar or the hammer. And the opposite is the bearish pin bar or the shooting star. Here's the anatomy of the pin bar. Here's the opening price level called the neck. The opening and closing of the bars is called the body. There are misconceptions about the color of this candlestick's body among traders. Some believe the color of the pin bar determines which is more powerful or not. Technically, the color of the body does not matter. While the lower long shadow on the bullish pin bar and the upper long shadow on the bearish pin bar is called the tail. The small shadow at the high or low of the body is called the nose. Take note, Sometimes there may be the absence of a nose on the candlestick formation. The most important factor which makes a pin bar be qualified as one is the tail must be at least 2 times longer than the total size of the body and the nose. The next Japanese candlestick pattern on our list is the harami pattern or inside bars. The word harami in Japanese means pregnant. This Japanese candlestick pattern is suitable for the continuation of an existing trend. These candlestick patterns consist of 2 candles, in which the second candlestick is inside the first candlestick. The first candlestick can be called the mother bar, while the inside candlestick is called the baby bar. The harami candlestick pattern can exist as a bullish inside bar or as a bearish inside bar. The pattern on the left-hand side is the bullish inside bar, while the pattern on the right-hand side is the bearish inside bar. The harami candlestick patterns tell us that the market is in an indecision period. Due to my years of experience in trading, it's best suitable for the continuation of a trend rally. That it's in a bullish trend whenever the bullish inside bar formed. Watch out for a buying position whenever the next bullish candle closes above the high of the mother bar, but make sure the bullish inside bar does not form near a resistance level. To trade the bearish inside bar, watch out for a selling position whenever the next bearish candlestick closes below the low of the mother bar, but make sure the bearish inside bar does not form near a support level. Take note, the baby candle can be at the center of the mother bar or at the closing or opening level of the mother bar. Here's an example of the bullish harami acting as a continuation of this bullish trend. Here's the bearish trend. We can see how the bearish inside bar acted for the continuation of this bearish trend. The next Japanese candlestick pattern on our list is the outside bars. This candlestick pattern consists of 2 bars. The bar on the left-hand side is called the bullish outside bar, while the bar on the right-hand side is called the bearish outside bar. The outside bar is similar to the engulfing bars, and it has the same technical implication. But the difference between these 2 bars is the engulfing candlestick engulfs totally the previous candlestick, while the outside bar 2 edges do not engulf totally the previous candlestick. To implement the outside bar for trade entry, traders need to focus trade entries at the upper or lower shadow of the second bar of the formation. A strong bullish close above the upper swing of the bullish outside bar signifies a bullish interest, while a strong bearish close below the lower swing of the bearish outside bar signifies a bearish interest. As we can see on this chart, this rally was in a strong bearish rally to the support level here. A bullish outside bar was carved, and which led to the reversal of this bearish move in this market. A pending buy order is suitable for the execution of this signal bar. Some outside bar candlestick patterns may be too long for an entry strategy in the market. In the later study of this trading course, you will learn how to implement the Fibonacci retracement tool to find the best possible entry level on long outside bar patterns. Here's another example of a bearish outside bar that reversed this bullish trend into a bearish rally. Traders must ensure there's enough volume in a market and that the outside bar will form at a well-defined key level before taking it for a reversal signal. The next Japanese candlestick pattern on our list is the 3 inside bars. This candlestick pattern consists of 3 bars. The 3 inside up candlestick formation is a trend reversal pattern that is found at the bottom of a downtrend. This triple candlestick pattern indicates that the downtrend is possibly over and that there's a high possibility for a new uptrend to start. While the 3 inside down candlestick formation is a trend reversal pattern that is found at the top of an uptrend. This triple candlestick pattern indicates that the uptrend is possibly over and that there's a high possibility for a new downtrend to start. There are 3 factors that make up the 3 inside up candlestick formation to be considered as a reliable candlestick pattern formation, and they are: Number 1. The first candle of the formation should be found at the bottom of a downtrend and should be a long bearish candlestick. Number 2. The second candle should be at least close upward to the midpoint of the first candle. Number 3. The third candlestick needs to close above the first candle's high to confirm that buyers have overpowered the strength of the downtrend. Likewise, there are 3 factors that make the 3 inside down candlestick formation to be considered as a reliable candlestick pattern formation, and they are: Number 1. The first candle should be found at the top of an uptrend and should be a long bullish candle. Number 2. The second candle should be at least close down to the midpoint of the first candle. Number 3. The third candlestick needs to close below the first candlestick's low to confirm that sellers have overpowered the strength of the uptrend. Here's an example of the 3 inside up candlestick patterns at the low swing of this trend. We can see how this candlestick pattern led to the upward movement in this market. Here's the action of the 3 inside down candlestick patterns at the top of a bullish trend. We can see how price found resistance and the market was reversed into a bearish trend. This is how to use the 3 inside up and down candlestick patterns to detect possible reversal in the market. The next Japanese candlestick pattern on our list is the tweezers tops and bottoms. This pattern consists of 2 candlesticks. The tweezers tops first candlestick is a bullish candlestick, and the second bar is a bearish candlestick, while the tweezers bottoms pattern first bar is a bearish candlestick, and the second bar a bullish candlestick. The tweezers top formation is considered as a bearish reversal pattern whenever it appears at the top of a bullish trend, while the tweezers bottom formation is interpreted as a bullish reversal pattern whenever it appears at the bottom of a downtrend. As we can see, they almost resemble the pin bars formation, but technically they are not. Remember, a reliable and genuine pin bar must have its tail times 2 the total size of its body and nose. The tweezers bottom happens during a downtrend when sellers push the market lower, but the next session price closes above or roughly at the same price as the first. The tweezers top occurs during an uptrend when buyers push the price higher. This gave us the impression that the market is still going up, but sellers surprised buyers by pushing the market lower and closing down the open of the bullish candle. This price action pattern is suitable to trade if we can combine it with other technical tools. The chart here shows us an example of a tweezer's top. We can see how it reversed the bullish trend into a bearish trend. The first bullish bar shows buyers were in control, but later sellers stepped in and shifted the market from the bullish side to the bearish phase. Here's an example of the tweezer's bottom after an aggressive bearish trend here. And we can see how the trend reversed into a bullish rally. To be on the safer side, do not trade this candlestick pattern if they are not formed at powerful support or resistance levels. The next candlestick pattern on the list is the piercing and dark cloud candlestick patterns. The piercing and dark cloud candlestick pattern is one of the most powerful technical signal bars you need to know as a trader in the financial market. This candlestick pattern can form at major key levels for reversal or for the continuation of a trend, or at the swings of trends in the market for pullback or resumption of an existing trend. The candlestick pattern on the left-hand side is called the piercing bar, while the candlestick pattern on the right-hand side is called the dark cloud, and which is the opposite of the piercing bar. The piercing technical candlestick pattern supports a bullish sentiment, and the dark cloud candlestick pattern supports a bearish sentiment. The piercing candlestick pattern can act for reversal of a bearish trend into a bullish trend, or as a bullish pullback in a bearish trend, while the dark cloud bar can serve for reversal of a bullish trend into a bearish trend, or as a bearish pullback in a bullish trend. For a piercing candlestick to be genuine, the next candlestick, which is the bullish candlestick, must have a lower low than the low of the previous candlestick, which is the bearish candlestick. Also, the bullish candlestick must have a high at the range of the midpoint or slightly above the previous candlestick, which is the bearish bar. For a dark cloud candlestick pattern to be genuine, the next candlestick, which is the bearish bar, must have a higher high than the high of the previous bar, which is the bullish bar. Also, the bearish candlestick must have a low at the range of the midpoint or slightly above the previous candlestick, which is the bullish candlestick. The next Japanese candlestick pattern on our list is the reversal candlestick pattern. Reversal bar formation is a single candlestick that reveals a violent display of strength, which suggests a change of market sentiment. The reversal bar candlestick can occur as the bullish reversal or bearish reversal. A bullish reversal bar pattern goes below the low of the previous bar before closing higher. A bearish reversal bar pattern goes above the high of the last bar before closing lower. For the bullish reversal formation, the market found support below the low of the previous bar. The support of the previous bar pushed the bar to close higher than the previous bar. This thus suggests a possible bullish reversal. While for the bearish pattern, the market met resistance above the high of the previous bar. Furthermore, the resistance was powerful enough to cause the current bar to close lower. There are two factors that make the bullish reversal candlestick formation be considered as a reliable candlestick pattern formation, which are, number 1, the lower shadow of the bullish reversal bar must be lower than the previous candlestick's lower shadow. Number 2, the close of the bullish reversal bar must close above the midpoint of the previous candlestick. Also, there are two factors that make the bearish reversal candlestick formation be considered as a reliable candlestick pattern formation, which are, number 1, the upper shadow of the bearish reversal bar must be higher than the previous candlestick upper shadow. Number 2. The close of the bearish reversal bar must close below the midpoint of the previous candlestick. As we can see on this strong bearish trend, after the bullish reversal candlestick appeared at the swing low here, we can see how the bulls stepped in aggressively, thereby reversing the previous bearish trend into a bullish phase. Here's an example of the bearish reversal candlestick in action at the high of the bullish rally here. We can see how price instantly found resistance, and the market was reversed into a bearish rally. The reversal candlestick is a powerful formation that usually signals a market at the overbought or oversold level. The next Japanese candlestick pattern on our list is the 3 white soldiers and 3 black crows candlestick patterns. The 3 white soldiers and 3 black crows bars are a powerful reversal candlestick pattern. The 3 white soldiers are the bullish pattern, while the 3 black crows are the bearish pattern. The 3 white soldiers pattern is formed when 3 long bullish candles follow a downtrend, signaling a reversal has occurred. This type of triple candlestick pattern is considered as one of the easiest to identify bullish signals, especially when it occurs after an extended downtrend. The first candlestick of the 3 soldiers is called the reversal candle. It either ends the downtrend or implies that the period of consolidation that followed the downtrend is over. For the 3 white soldiers pattern to be considered valid, the second candlestick should be bigger than the previous candle's body. Also, the second candlestick should close near its high, leaving a small or non-existent upper wick. For the 3 white soldiers pattern to be completed, the last candlestick should be at least the same size as the second candle and have a small or no shadow. The opposite of the 3 white soldiers pattern is the 3 black crows candlestick pattern. It is formed when 3 bearish candles follow a strong uptrend, indicating that a reversal is about to play out. The second candle's body should be bigger than the first candle and should close at or very near its low. For the 3 black crows pattern to be completed, the last candlestick should be at least the same size as the second candle and have a small or no shadow. Here's the formation of the 3 white soldiers at the low of this aggressive bearish trend. The formation of the 3 white soldiers gave an indication of the bullish interest willing to reverse the trend to the upside. What happened after this formation? We can see the bearish trend ended instantly, and the bulls reversed the trend into a bullish rally. Here are the 3 black crows in action. We can see it led to the reversal of the bullish trend here into a bearish trend. The next Japanese candlestick pattern on our list is the Hikaki candlestick pattern. The Hikaki candlestick pattern is a tricky candlestick formation, thereby making it a complex signal bar. The Hikaki means to trap or trick, and this is why inexperienced or new traders are advised to stay off this candlestick pattern. Also, a well-analyzed money management system is essential if a trader wishes to implement this formation for trade anticipation. The Hikaki pattern is made up of a short-term decline in market volatility. After the decline is over, it then shows a breakout move in price action. This candlestick pattern can occur altogether as 5 or 6 candlesticks. This is one of the reasons it's been tagged as a tricky or trap formation for traders. The 2 formations on the left-hand side are the bullish Hikaki patterns. Pattern A is the 5 candlesticks formation of the bullish Hikaki pattern, while pattern B is the 6 candlesticks formation of the bullish Hikaki pattern. The other two formations on the right-hand side are the bearish Hikaki patterns. Pattern C is the 5 candlesticks formation of the bearish Hikaki pattern, while pattern D is the 6 candlestick formation of the bearish Hikaki pattern. Let's study pattern A, which is the 5 candlesticks formation of the bullish Hikaki pattern. As we can see, the 5 candlesticks bullish Hikaki patterns begin with a bearish inside bar, followed by 2 consecutive bearish candlesticks. This tricked or trapped traders to sell, believing the bearish inside bar is confirmed. Suddenly, the selling market sentiment changed violently into a bullish candlestick, and traders who are selling were trapped in a short losing position. The opposite occurs on pattern C, which is the 5 candlesticks formation of the bearish Hikaki pattern. The pattern formation begins with the bullish inside bar. This bullish inside bar deceived traders to buy. And along the way, the buying market sentiment changed suddenly into a bearish market, and buyers were trapped in a long losing position. While pattern B, which is the 6 candlesticks formation of the bullish Hikaki pattern, formed a bearish inside bar. This bearish inside pattern was followed by a third bullish candlestick, but the opening of this third bullish candlestick gapped low. The next 4th and 5th candlestick formed bearish candlesticks. The 4th and 5th candlestick opened below the closing of the third bullish candlestick. We can see the irregular formation of the 3rd, 4th, and 5th candlesticks. This was the early signal that the price flow in this market is suspicious. The 6th candlestick suddenly open and close above the high of the 1st candlestick of this pattern. This bullish sudden action shows the bears lost the battle and that the bulls won. And now the bulls are now in control of the market. So it's time for traders who are selling to cut their losses. Pattern D is the 6 candlesticks formation of the bearish Hikaki pattern. The pattern formation begins with the bullish inside bar. This bullish inside bar deceived traders to buy. This bullish inside bar was followed by a third bearish candlesticks, but the opening of this third bearish candlesticks gapped low. Then the next 4th and 5th candlestick are bullish candlestick. And suddenly, the bearish pressure increased violently, thereby closing below the low of the 1st candlestick of the pattern. Now you can see why it's referred to as a tricky and complex candlestick pattern. Okay, here's a good example of the bearish Hikaki pattern acting for the reversal of a bullish trend into a bearish trend. We can see how buyers were tricked and trapped in this market, and the market sentiment changed suddenly into a bearish rally. A trader with the knowledge of the bearish Hikaki pattern would have exited this trade at an early stage. Likewise, here on this chart, we can see how the bullish Hikaki pattern acted for the reversal of the bearish trend into a bullish trend. To be on the safer side as a beginner trader, implement it for an exit strategy in the market. Once you have mastered how to utilize it for an exit strategy to prevent the accumulation of bigger losses, then you can proceed to implement it for trade entry.